What's up, everybody? Welcome to Heresy Financial. My name is Joe Brown, and today we are talking about tail hedging. We're going to look at a brief history of risk management in the stock market. We're going to look at some additional resources that you can explore about risk management in trading and investing. We're going to look at why right now might be a perfect time to consider something like tail hedging for your portfolio, and we'll look at concrete examples of exactly how you might employ this with your own investments. Let's dive in. All right, so today we are discussing tail hedging, and if you have any experience with investing whatsoever, if you've ever read any, basic books about investing, you've likely come across something called modern portfolio theory, or the efficient frontier, or the 60-40 portfolio, something to that effect. Basically, the theory behind these portfolios and this concept is that the markets are governed by a normal distribution. Now, if you're not familiar with the normal distribution versus a power law curve, a power distribution, or a skewed distribution, my favorite resources for understanding these and the significance of how these actually play out in real life is pretty much any book or writing by Nassim Nicholas Taleb. My favorite books by him are The Black Swan, Anti-Fragile, and Skin in the Game. I think from a risk management perspective, you cannot do better than reading each of these three books multiple times. I'll have the Amazon links in the description below, but in these books, he talks about how in life there are really two areas, and everything in life either falls under a normal distribution or a power distribution. Now, let's backtrack. We have some Nobel Prize winners who came up with the options pricing model called the Black-Scholes model. It was made up by three guys. Their last names were Merton, Black, and Scholes. Merton got cut out of the name of the options pricing model. But these guys started a hedge fund called Long-Term Capital Management. Now, many people have never heard the story of long-term capital management, and I won't bore you with the details right now. It's a fascinating story. Much has been written about it in some very good writings. But ultimately, this firm operated under the assumption that the options pricing model itself operates under, which is that markets are governed by a normal distribution. It's also called a bell curve. Now, long-term capital management used this assumption of the way that the markets worked in order to determine what trades they were going to do, and it gave them a mathematical foundation for being able to say, hey, this is exactly how much risk we are taking on with our trades. And so they were the first of what's now called a relative value hedge fund, where you have two things and you're going to buy one and you're going to short the other, and you don't really care about the absolute movement of, if both of these things go up or both these things go down. It doesn't matter to you because you're long one and you're short the other. So if they both go up, that's a neutral move for you. If they both go down, that's a neutral move for you, because you make money on one, lose money on the other, and they offset each other. But what you are concerned with is the relative value between those two things. And so you're going to buy the one with currently the lower value, and then you're going to short the one that currently has the higher value, with the assumption that statistically the values of those two will converge. So you're not concerned with the total value of the two. You're concerned with the relative value, that they will converge to back towards each other. And so whenever you have discrepancies, whenever they saw discrepancies show up in the marketplace, for instance, between U.S. Treasuries, sometimes they could short and buy the same U.S. Treasuries at slightly different prices, knowing that they're the exact same investment. And so if you've bought one and you've shorted the other, it doesn't matter what happens with yields, doesn't matter what happens with the price of the Treasury. They're the same thing. And so once they mature, in the end, they're going to converge to the exact same value at some point. And so by being able to short one at a higher price and buy another at a lower price, you've engaged in a risk-free trade because the relative value of the two will converge. Now, obviously, you can't make a ton of money doing this strategy just straight up. And so what they had to do in order to make money is borrow, and then their return on their own capital was huge because they're borrowing enormous sums from banks. And so if you pick up a nickel on a bond spread, just doing that once, that's not much. But if you can do that with massive amounts of leverage, then you start making some money. Well, even that wasn't enough. And so they used their models to push past just straight treasuries. They looked at other bonds. They looked at emerging market countries. They even started looking at equities towards the end, using their mathematical models to construct relative value trades that theoretically, according to their models of how the markets worked, should eventually converge. Well, the story ends with long-term capital management blowing up like nobody expected, and their trades were so big and they had so much money throughout the markets that they actually threatened to take down, like dominoes, take down the entire global financial markets. Because part of the problem with a relative value trade is that when you're short the one with the higher value and long the one with the lower value, you expect them to converge so that you can then close them out at your profit. But when you close this trade out, this one you're short. You have to buy this one to close it out. That's how you close out a short. You buy it to close. And this one is the one that you've bought. You're long this one. In order to close out a long, you have to sell it. Well, when you have a massive position in something, when you buy it, that's going to push the price up. And when you have a massive position in something down here and you have to sell it to close it, that's going to push the price down. And so their trades were so enormous by the end. They had so much leverage and so much money in really illiquid markets all around the world that by them just starting to close out some of their trades to take risk off the table, it made their losses even worse. They were pushing the markets against themselves. Now, they weren't the only ones doing this. There were other banks, investment banks, other companies and hedge funds that had started engaging in this type of trading all over Wall Street. And so when everybody started to hear about the trouble that long-term capital management was in, they all started to close their trades out. But again, everybody was doing the same trades. And so by everybody else getting out, it made the problems even worse. And so eventually Wall Street got together and a bunch of the big banks got together and they basically performed a bailout, and they bought out long-term capital management and then let the trades die off. They took the losses on themselves. Now, that's a long backstory just to highlight to you Nobel Prize winners who were considered some of the smartest investors in the world at that time constructed a trading strategy that, number one, on paper should have worked, and number two, was so close to reality that all of Wall Street, all the big banks were loaning them so much money that it actually put the entire global financial system in jeopardy. And since they were so close to reality, they missed the fact that they were just operating on one wrong assumption that made it seem like the thing that almost took them out, with yields going the wrong direction for a longer period of time and to a greater extent than what they should have. The thing that wiped them out, their calculations and their models said should not have been able to happen given the entire history of the universe. If the markets had been operating that long, they shouldn't have seen that event. That event was so rare and so extreme, they shouldn't have seen that event happen in the entire history of the universe. And the problem is that these models never died. Most financial models and most markets and most investment managers, portfolio managers, operate under these same assumptions, that the markets are governed by a bell curve, a normal distribution. And this means that events that we've seen happen dozens of times in the last few decades theoretically should have never happened given multiple lifetimes of the universe at this point, with how many times we've seen these types of events happen. Okay, so when you have a mathematical model that tells you A, B, or C shouldn't happen given hundreds of billions of years, they're so extreme and so rare, but you see events that fit that classification happen dozens of times over just a couple of decades, your model's probably wrong. So then what we need to do as wise investors and as prudent traders in order to manage risk, we have to look at history and we have to look empirically at what actually happens and not rely on some models just because some smart person said it was true. We have to look at history and evidence and empirically look at what the data says, not on what the models and the theories say should be true. So let's look at SPY, good proxy for the stock market. It's an ETF that invests in the 500 companies that are part of the S&P 500. Now, if you're just the standard investor, the typical investor, and you're just, investing in your 401k for the next 30, 40 years, you don't care what the market's doing right now, then your account is probably invested just like the modern portfolio theory says. Now, just for simplicity, let's say that means you're a young professional. Let's say you've got 100 shares of SPY in your portfolio. Just for round numbers to make this example easy, you've got 100 shares of SPY in your account. That means that as of today, you've got about $33,000 in your account because SPY today closed at about $335 per share. So you got about $33,000 in your account. At the beginning of this year, your portfolio would have been the exact same value as it is today. The S&P 500 is basically at the exact same spot that it was at the beginning of this year, up until the pandemic hit and everybody started freaking out and then selling a ton. There was a giant sell-off, markets rallied back. Now, this video is not a video about the problems with the economy. This video is not about my judgments about where I think the market should be or its values. This is simply a description of what the market has done in the past 7 months. So if you're this type of person that's just like, hey, I'm throwing money in, I'm investing for the long haul, I don't even check the markets, I don't care what's going on. You looked at your portfolio at the beginning of the year, you look at your portfolio today, no difference. You're like, hey, I was fine. I did the right thing. Modern portfolio theory was right. I'm just supposed to put money in and it'll eventually come back. Here's the problem. The markets didn't end today. You still have the future, number one. And number two, you might be investing for the long haul today, but that doesn't mean you're always going to be able to invest for the long haul. At some point, you're going to need to use that money. So instead, if you're the type of person that I don't know, maybe in March or April, you lost your job and all of a sudden you needed to access funds that were in your investment portfolio, you're no longer able to write it out. Now you have to sell investments at the bottom and access funds at a steep discount, and you didn't actually have the capital there that you thought you did. And so this is where tail hedging comes in, because number one, extreme events happen. The markets are not governed by a normal bell curve, a normal distribution. So tail hedging implies that the distribution of the markets is skewed, which means that it has fat tails, which means that extreme events can happen and do happen with relative frequency. And so tail hedging is different from a normal hedge where it's like, hey, we're not just going to buy one. If you have 100 shares of SPY, we're not just going to buy one put at the money on SPY in order to completely buy insurance on your portfolio, because number one, that's expensive, and number two, that only offers you basically a floor under your investment and doesn't offer you any other advantages. You still only make money if your investments go up. Tail hedging is operating under the assumption that these extreme events happen and we are protecting ourselves in the case of those extreme events happening. We're not concerned really about the little day-to-day, week-to-week, month-to-month fluctuations in the stock market. We're concerned about purchasing 100-year flood insurance. Okay, so in our example, we had the investor who has $33,000 to his name, 100 shares of SPY at the beginning of the year, $33,000, and right now, $33,000. But let's change it up. Let's say you're the type of person that had engaged in tail hedging. Well, because the markets are at a very similar price right now as they were at the beginning of the year, I'm going to use some options pricing numbers given what the market is at right now, and understand that in times of higher volatility, options are priced higher. And so right now, options are more expensive than they were at the beginning of the year, especially puts. So that means that this strategy would have been even more effective, dramatically more effective, given you starting this strategy at the beginning of the year versus right now. But we're going to use today's numbers just to highlight exactly how effective it can be. Now, let's say that you're concerned about a 10% drop or more in the S&P 500 within the next 2 months. Let's say you think we're going to hit that, that $3,400 mark on the S&P 500, and we're going to then have a sell-off from there. You think maybe there are some other concerns that might happen. Maybe it's with the election or bankruptcies or whatever your concerns are. Let's say you're concerned about a 10% drop in the stock market. Well, that would make your portfolio value go from $33,000 to about $30,000, give or take. Now, right now, given the normal distribution of events, a move at about 3 standard deviation points away from the current price would put the market right around 2,600, or for SPY that'd be 260. So let's just pick that price point. This isn't an exact science. You can be a little bit loose with this. There's wiggle room for your own discretion here, but just for the example, let's buy some 260 puts. Those are going to cost us $1.36, and so $136, because they're options, you have to multiply by 100, and this is tail hedging. And so we're not just buying one because we're not banking on the S&P 500 going to zero. We want to be able to cover ourselves. We want to be able to make enough money on these puts to make up for our losses in our actual position with a smaller move than it just going to zero. So we're not looking to buy one, we're going to buy 10. So that's going to cost us about $1,300. And again, we're looking about 2 months out. So today is August 10th. So we're looking at the October 16th expiration date on these. So we're spending $1,300 and we're getting 10 contracts, the 260 strike price puts on SPY. Again, we already have a position of 100 shares of SPY. So we're scared about a 10% drop. So let's see what a 10% drop would do. Well, a 10% drop puts our position, our SPY position, our share position from $33,000 down to about $30,000. Now, based on the options pricing model, which again, the options pricing model in situations like this is too conservative because it assumes a normal distribution. But we're going to use the conservative numbers here. The options pricing model made by Black-Scholes, it says that these puts would go from about $1.30 per contract to just under $5 per contract. And so on the option position, because you bought 10 contracts, you're making about $3,500 on a 10% drop from where SPY is right now. And so that just a little bit more than covers your loss on the actual share position. Now, the other thing to keep in mind is that options prices are heavily influenced by volatility. When you have volatile events like a big drop in the stock market, many people rush in to buy options at that point, which just supply and demand, that makes the actual prices of those options go up, in addition to the risk of them actually going in the money. And so the intrinsic value and what the market makers are willing to buy and sell them at. The options premiums on both sides of the market, calls and puts, they both increase in price. And so at the conservative level, your $1.30 goes to about $5, which again, just a little bit more than compensates you for your total loss on your portfolio. So that means a 10% drop happens tomorrow. Your total account value, your shares plus your options, it doesn't change. And the nice thing about this is that you're only insuring yourself against these extreme events. You don't care about the little fluctuations. So you don't have to buy these puts way closer to the money. So you're getting them for a lot cheaper. You're having to put up a lot less capital for the amount of protection you get against the extreme events. Now, let's say something even worse happens. Let's say you get what happened in February, March, April, where you have, let's say, a 20% drop in the stock market. Well, a 20% drop in the stock market puts the S&P 500 from here right about 2,600, 2,700. So that puts SPY at 267. So your positions, your actual shares, you just lost $6,000. You went from 33 grand to 27 grand. Well, your options, remember, you don't just have one, you've got 10 of these contracts. And so just on the price movement alone, that puts the price per contract from where it is right now at $1.36 to about $14 per contract. So that means your $1,300 committed to your puts is now worth about $14,000. Again, that's assuming no change in volatility. So this is the most conservative estimate if this move was to, even if it was to happen tomorrow, a drop in 20%. At the minimum, these puts would be worth $14,000 for you. So now you're not just covering yourself against these extreme events, you're making money on the extreme events. You've more than made up for, you've doubled what your loss was. And so now your total account value is $40,000. So if the market just continues to go up, your shares keep making you money and then your puts expire or your puts become worth less. But in an extreme event, you actually start to make money because you've bought more puts than the actual shares that you own. And because you're buying them for these extreme events so far out of the money, you're not having to put up a lot of capital for them. Now, there are so many ways to apply this tail hedging strategy. If you own gold in a safe at home, you can buy puts on GLD. If you're a real estate investor and you have lots of real estate that you have renters in, you can go find some REITs, some real estate investment trusts that are publicly traded with options on them, and you can buy some puts on those just in case something crazy happens in the real estate market. If all of your investments are in your retirement account and you can't actually buy options in there, you can do this strategy with just a regular brokerage account. And then if your retirement account plummets from an extreme event, that means your brokerage account is going to skyrocket in its value. And so then for a couple months, just jack up your 401k contributions, put most of your paycheck into your retirement account, and live off of the money that you made from your puts increasing in value in your brokerage account. You're just turning income then. You're deferring your income taxes by putting that into your retirement account. You're turning that income into capital gains. And so there are many ways, many creative ways that you can apply this to your own specific investment scenario. And so none of these are advice. None of these are recommendations. These are just ideas, helping you think of ways that you can protect yourself against a market that is not governed by the rules that the professionals say it is governed by. And the reason why I'm bringing up tail hedging now is because we've had a decently long period now of low volatility, where volatility has just been steadily decreasing. And so at a point like this, we're starting to see options prices get back down to a little bit more of the normal ranges historically, and so it's not as expensive to initiate a strategy like this as it would have been, a month ago, especially like 2 months ago. Because if you wait until your house catches on fire to go buy fire insurance, you're likely going to be paying more for that fire insurance than the fire insurance company will pay you to rebuild your house, and so it won't be worth it. All the people who bought puts as the market was, falling and tanking, reaching those lows, they were so expensive that you would have needed another 20, 30, 40% loss in the stock market for you to even break even on those. And so going forward right here, as we're experiencing more and more madness from monetary policy, fiscal policy, as all of the policymakers and people in charge are pulling out all the stops to kill price discovery, kill free markets, nationalize all stocks in the credit markets, and just do some of the craziest things we've seen financially in our country's history. It's more important to be thinking about ways to manage your risk in a way that is cost effective and strategically effective. All right, so resources. If you want some resources on this, here we go. The first thing I'm going to recommend is my options course. If you want to be able to understand some of these things that I'm talking about, and you're a good investor, good trader, but you've never touched options, take my options course. It's in the description below. The second resource is a book called The Dao of Capital. Now, this guy, Mark Spitznagel, he is currently writing another book actually on tail hedging. It's coming out at the end of this year, and it's pretty funny actually, because he started writing this book about how it's important to hedge yourself against extreme events before the coronavirus pandemic actually hit. He started writing it last year actually, and so I bet a lot of people are going to think that he wrote it because of this event. He started writing it before, but his earlier book, The Dao of Capital, right here, it's a fantastic book, and it goes really well into detail on his tail hedging strategy for his hedge fund. Nassim Taleb, who I mentioned earlier, I'm linking all of his books that I like in the description below as well. He's good friends with Mark Spitznagel, and he either wrote the foreword or just said some good things about the Dao of Capital as well. So I recommend the Dao of Capital. I recommend Black Swan, Anti-Fragile, and Skin in the Game, by all three of those by Nassim Taleb. Those are some of the most fantastic books on risk management that you will ever have the privilege of reading. So I recommend all four of those books, and then my options course as well. I'll link all of those in the description below. And if you want one of my End the Fed t-shirts, you can get it in the merchandise shelf that is right below every video. This is the tri-blend jersey knit, and so it's a really comfortable, really durable cloth that the shirts are made out of. So thank you so much for watching. If this video is helpful for you, please hit that like button and share it with somebody who would find it helpful as well. You guys are the best. Have a great day.